Hello and welcome to this fund update video. My name is Damien Yeomans and I lead Credo's fund distribution in the UK. I'm joined today by the manager of the Credo Global Equity Fund, Jarrod Cahn. Jarrod, welcome. Can you start by taking us through the investment style of the fund?
Thank you, Damien. So I think it's important just briefly to talk about Credo's investment philosophy. We believe that wealth is best created and preserved through patient and disciplined investing, and we focus on the long term. What's key to our investment philosophy is that we are a value-based investment house. We like to look at high quality companies that are attractively priced, and it's imperative that they have great prospects in terms of future earnings. We try and avoid short-term noise and look for dislocations in stocks to take advantage of quality businesses. As part of our value investment philosophy, it's been quite interesting to follow the bad performance or the poor performance of value over the last couple of years. And what I've pulled up here is just a graph of the relationship between value and growth over the last 90 years. And what you see is the 0% line, and everything above the line is times where value has outperformed growth. And every time that the line goes below the zero is when growth has outperformed value. And what's been obviously quite clear is that since 2010, so effectively the last decade, growth has significantly outperformed value. And particularly over the last 6 months, if you look right to the right edge of that graph, you can see a massive dislocation where value is, the relationship between value and growth is the most dislocated that it's ever been. To understand this, I think it's important just to go back briefly to the history of value investing and to see how maybe some of the fundamentals that were used historically have changed. So we go back to the 1930s, to the fathers of value investment, Benjamin Graham and David Dodd in security analysis. When they came out with their book in 1930, the type of companies that they invested in were companies like steel companies, railway companies, rubber companies. These are very, very cyclical industrial companies that had significant fixed assets. So in terms of trying to work out an intrinsic value for these companies, it was very, very easy. You could look at the value of land, you could look at the value of the stock, and you could find a liquidation value, and you would find some kind of margin of safety if there was some kind of fire sale. If you fast forward then to 1970, to the likes of Warren Buffett, where he's also now become known as a great champion of value investing, Buffett brought something a little bit different to the value theme. And this is understood in terms of the qualitative nature of the type of stocks that he invested in. And again, the types of stock around 1967 were companies like IBM and Eastman Kodak. So already companies that weren't that cyclical in terms of their movement. But probably most importantly is if you move forward to where we are today, around 2020, and you look at the 5 largest companies by market cap in the US, it's interesting to notice that these companies are all IT companies or technology companies. And when you try and put intrinsic value onto these companies, it's very, very difficult to value. How do you value the platform network business of Facebook, or the patents of a company like Apple, or even a company like Amazon that for lengthy periods of time didn't actually earn money and just kept reinvesting its cash flows to grow the business? So I think it's very important, again, to try and assimilate some kind of value investment theory to the way the market has moved forward. And that brings us kind of to where Credo thinks in terms of their investment when they talk about value.
How would you describe Credo's definition of value investing and how it may differ from other investors?
So the first point that I'd make is that a cheap valuation is not an absolute number. Just like, everyone thinks that value stocks are low price to earning stocks, we do buy stocks that obviously trade at a premium to the market from time to time. So when we do look at valuations, we consider a number of factors, both qualitative and quantitative. But I guess what's key is to look at a company's future earnings potential. And then what we try and do is look at that valuation possibly relative to its peer group, relative to the company's own history, and also relative to the market. And what we want to try and do is find dislocations where that valuation looks compelling to us. We look for dislocations in the equity markets And we find that dislocations happen when certain events happen, such as regulatory change. When, for example, the UK regulators changed the gaming laws, and with that, we took the opportunity to buy a company like Flutter that was trading at a significant discount. Again, political worries, like in the US, where we had Elizabeth Warren and Bernie Sanders talking about Medicare for all, gave us an opportunity to buy two great US healthcare names, HCA and Cigna. Then we have things like spin-offs, where companies break up the sum of the parts of the business, where we believe that either the market just doesn't properly research these companies, or because certain parts of the business are just too small, they get indiscriminately sold off, and that gives us an opportunity to buy these stocks at a great level. Then you have things like changes in the business cycle, where stocks are temporarily mispriced because of margins that are, for example, temporarily impaired, where they screen very expensively, but in fact, with a bit of research, you realize that these companies are actually quite cheap. And then you have, again, things like sector consolidation, where an acquisition or a merger between, say, Stars Group and Betfair in Flutter gives you a great synergistic company. And ultimately, what we try and do is try and eradicate the short-term noise around these companies and look at the long-term prospects. And as long as we believe that these long-term prospects are still very much in favor, we look to try and buy these companies. Clearly, COVID-19 has put a bit of a spin on things, where there's been a significant amount of short-term noise. And some of that has led to temporary dislocations. And clearly, there's been opportunities where we've had to consider where these would also be long-term in terms of a substantial structural change to our equity thought process and investment thesis.
Thank you. So talking of the coronavirus pandemic, how has it influenced your thinking, and what type of businesses can thrive in the current environment with lockdowns in place around the world?
So a big part of what we've done over the last 9 weeks is to try and differentiate between companies that are temporarily structurally challenged and then long-term changes of behavior in society. So it's easy to kind of see the short-term changes. A company like Boeing coming out and saying that the airline industry is likely to see insolvencies. It's going to take them 3 to 5 years to get back on their feet. Now, this is a structural change that's going to affect the civil aviation industry. So if you're in stocks like Meggitt and Raytheon and the like, you need to be aware of that. On the flip side, you've had beneficiaries of the pandemic, where Microsoft had benefited massively from the work from home environment, where they've come out with statements saying, 2 years worth of digital transformation has happened in 2 months as everyone's moved towards the enterprise business. Again, fixed cost businesses like the automakers avoiding disaster, offering zero financing on cars just to keep cash flow going and trying to create some business. And then some quirky businesses where they've seen a purple patch, so the supermarket chains, where there's been a run on toilet paper and stockpiling and the like. And the question is, are these long-term trends going to dissipate, or whether, it's sustainable? Other examples could be, the video gaming sector, where pent-up demand while people have sat at home and played games has benefited some of these companies. The likes of a Netflix have been, again, another huge beneficiary. But as the lockdown starts eroding and people get back to a new normal lifestyle, clearly these tailwinds become headwinds. So probably more strategically is to look where there are significant long-term structural changes in the world. And we've identified probably 4 easy ones. We have Jack Dorsey coming out, CEO of Twitter, and saying, if you want to work from home, please do so for the rest of your lives. That has a significant impact on the way people do business going forward. If you're a commercial property owner, I think you need to sit up and listen and really be concerned. Again, the click culture, people staying at home and shopping online. Online has taken off and has been taken to a new level. So the likes of Amazon have benefited massively. The corollary of that is if you're a retail landlord, retail's already been in structural decline. All of a sudden, you've had the concern that shopping centres are really a place that people may not want to go anymore because they are fearful of the pandemic and what that effect will have on their balance sheets, which are already very much impaired. And then another aspect which is very clear from this is that interest rates are likely to remain low for an extensive period of time, and therefore the impact that that may have on, say, the banking sector or the insurance sector. So we've had to think a little bit more in terms of long-term structural changes and try and position our portfolio to either benefit that or to avert risk by cutting some of these stocks that have been exposed. And so what we've done is we've looked at certain other structural things and qualitative things which you would maybe take for granted in a normal environment. So just the ability to operate your business, which is an assumption that I think everyone makes when analyzing a business. We've had to relook at that. Can a business keep operating? Can British Airways keep flying its fleet? If it can't, do they have the ability to cut staff, fire employees? Do they have some kind of government aid, the furlough scheme? If they close certain facilities, can they close some without closing the others? Is a restaurant chain able to operate profitably just at a 50% capacity? If you have a supply chain disruption, it's one thing for Apple to be selling a whole lot of iPhones, but if they can't get access to the components of those phones, what's the use of having all the orders? So these are aspects that we've had to take into account when looking at companies. Also very important have been the proactiveness of management and how they've been able to adapt to this environment. So how flexible are companies in cutting costs? A great example of that is a company like Crown Resorts that happened to cut their costs by 90% versus Genting, which was a competitor of theirs in Asia that couldn't. Significant competitive advantage. Skillful management, adapting business models. And then probably the key to all of this has been resilience through the downturn. And that is around financial structuring. So how leveraged companies are, how strong their balance sheets are, and the availability of resources. Do they have cash and do they have access to credit facilities? And if they don't, and there's a chance of an equity raise or convertible debt, what's the value destruction to shareholders? And when you've analyzed all of that on top of what we've done over and above what we normally do, you've got to come out with some kind of valuation and have to decide as to whether these stocks still do offer value. So it's one thing to say Amazon's a great business and it's benefited from the COVID environment in one sense. But if a stock now is trading at a COVID premium, what's the use of buying the stock right now when it's priced to perfection? And these are the kind of stocks and thought processes that we've had to consider now in our input when we look at stocks and valuations.
How has the portfolio changed in light of coronavirus this year, and how is it currently positioned?
So as I've suggested before, what we've tried to do is look at each individual company based on sensitivities, initially balance sheet strength and just ability to operate their business. And we've effectively divided the portfolio into certain buckets. We have what we call the core bucket, which are defensive type of stocks that have either benefited or been neutral under the COVID kind of environment. Resilient business models with strong balance sheets and still stable compounding returns. And that still forms the bulk of the portfolio. Then we shift to the middle ground of the portfolio, which we would say are quality businesses that have been temporarily impacted. So quality franchises with business models that remain relatively competitive, but because of various shutdowns and quarantines have been temporarily depressed. And then you have the third bucket, which fortunately is a very small bucket for us, which we would consider as the ICU bucket. These are companies that were caught very badly by the coronavirus in terms of their structural business models, and all aspects of the business have been affected, profitability and operations. And there you've had, you can have the potential of binary outcomes. So these are interesting companies where, you either go big or go home, for example. As I say, they're not a big portion of the portfolio, but they do represent a small portion. And we've tried to balance the portfolio in such a way where, as the rotation out of the more defensive stocks move into the middle and to the lower end of the bucket as the quarantine periods and the shutdowns start becoming undone. We try and move the portfolio into a more dynamic and fluid environment. And if we just kind of put a few names behind the structuring of that portfolio, I've alluded again to a few of these stocks in the past. So the big beneficiaries of Corona are companies like Microsoft, or Verizon in the US, defensive names, IG Group in the UK, which is a spread betting company that thrives on volatility, which we haven't seen for many years. Progressive, which is a large car insurance company in the US that has benefited from people not having the ability to actually drive. Facebook has been a massive beneficiary. Alibaba, another one. And then in the middle bucket, companies like Madison Square Gardens or Crown Resorts, Chubb and Arch, which have been impaired because of the concern around business interruption insurance, the financials like Wells Fargo, and then slightly more speculative companies like On the Beach, which is a small UK platform tour operator, and JD Group, which is a stock that we think is a great quality business and an expression of the athleisure sector, and again, an exponent of an extension of Nike and Adidas. So these are the type of stocks that make up the portfolio, all very large cap quality businesses, but for one aspect or another, are looking on a different risk profile on the spectrum of the portfolio.
Could you give us an overview of some of the main holdings in the fund?
Right, so if we look at our top 10 holdings, Facebook is our biggest holding at present. We bought Facebook a long time ago when the Cambridge Analytica and scandal around GDPR and data was about, and the stock traded down significantly. Clearly, it's been a neutral beneficiary of the coronavirus in the sense that advertising revenue on the one hand has dropped, and we believe that this is a short-term drop because we think that the ability to advertise on platforms like Facebook and Instagram are key to the business out there, and they will come back much quicker than traditional type of advertising. And we're also very comfortable and quite excited actually about the Shopify deal that's just been announced. And the valuation of Facebook is still relatively inexpensive to where it's traded in its history, although it's traded at an all-time high. And we think that there's significant earnings growth there. We also have Microsoft in our top 10. That for a long time has been in fact our biggest holding, and we've just trimmed there. Microsoft, again, a significant beneficiary of Corona. The enterprise business has grown significantly, and as we've seen with things like Teams, how important it is in a work from home environment. So we are very comfortable with companies like Microsoft. I alluded before to the healthcare sector and how that had been impaired due to political worries, and you can see Cigna and HCA making up two of our top stocks in the top 5 holdings. Flutter Entertainment, which was Paddy Power Betfair, is now 4th. In fact, after the placing that happened last Thursday, we are extremely excited about the prospects of Flutter in the future, particularly given the sporting live sporting over the last 3 months has actually been shut down in the UK, yet the company is trading at an all-time high. We think the prospects for the US sports betting industry is massive, and it's actually underrated. And we think that Flutter represents an opportunity of not only value, but a growth company that could see significant upside over the coming years. Then we have Alibaba, which again is, as you want to call it, the Amazon of China, effectively. But the difference is you don't pay a ridiculous multiple for Amazon. We bought Alibaba at a time when tension between China and the US was high. This was a stock that was trading on a 35 times multiple. It then started trading on a 25 times multiple. We thought there was a great opportunity to buy the stock, and hence we bought it. Crown Resorts is a casino operator in Australia. Again, counterintuitively, you would think that the leisure sector would be significantly impaired. We like Crown, and we've actually just increased our holding in Crown because we think the balance sheet is very strong. When we look at Australia as a model country in terms of dealing with the pandemic, we think the pent-up demand gaming or gambling is significant, and we think that this company will bounce back very quickly. They've managed to cut their costs much stronger and quicker than some of their competitors like Genting, and we do believe that there is a very real chance that in the next 18 months, a company like Las Vegas Sands or a Wynn Group could actually buy Crown Resorts. And we have Walt Disney, which we've held for a lengthy period of time, and Madison Square Gardens, which are two stocks that we'd kind of classify in the same basket as companies that rely on live entertainment or people in theme parks. And while this has been impaired for a period, we think that the recovery in these stocks will happen. In the case of Disney, you have had the upside of Disney Plus that has exceeded expectations, and we think that's the silver lining in the stock over the short term. But over the long term, such a quality franchise will continue to grow. And then in the case of Madison Square Gardens, the ability to buy, again, a trophy asset franchise in the format of the Knicks at a very, very significant discount to where it traded 3 months ago is just a gift. So we're excited about a stock like that, irrespective of the fact that the NBA and live sport in the US has actually stopped for a while. And then Beckel is a Mexican company better known for Jose Cuervo Mexico. They're the biggest producer of tequila in the world, and they've actually been a beneficiary of this in the sense that the Mexican peso has dropped off by about 25% against the dollar, and they produce most of their production in Mexico. So hence another strong beneficiary while selling their product offshore. So that gives you quite a comfortable snapshot of the top 10 holdings. And if we just had to break that down briefly into a sector allocation, it's quite well diversified across the board. One point I'd make is if you look at the green slither on the left-hand side, the information technology only forms 9.4% of the portfolio, which is relatively low when you think of how strong the FANG stocks or the technology stocks have been. And again, just applying our value principles, we can't own a large number of these technology companies because they screen very expensively. But I'll also just caveat that by saying, companies like Alibaba and Facebook come under different sectors, communication services and consumer discretionary. So it's a little bit misleading. We have about 20% of the portfolio in techie type names. And then from a currency allocation point of view, we are still heavily weighted towards US dollar assets and the US market. The reason for that is that we believe that the best companies are to be found in the US, best management teams, transparency, liquidity, financial reporting. And for that reason, we're very comfortable owning these stocks, even though the market does trade at a premium to some of the other markets around the world. But inevitably, we're happy to pay a slight premium for that quality.
The fund is quite concentrated and is benchmark agnostic with a high active share. Are you happy to leave out some big stocks such as Amazon and Apple?
Very much so, Damien. And I think this goes back to the point about sticking to your investment philosophy. We are value investors. We do have a quality slant. We are not growth investors. And while growth has obviously been the place to be, and everyone wants to own the Fang Dangs and all these fancy names, we have to, at the end of the day, look at valuations. And as much as I love using Apple products and as much as I love Amazon as a company, when I look at the valuation of Amazon, it's very difficult to justify owning that on a price to earnings multiple. And you need to obviously use very different metrics, but it's a growth company that we're just not comfortable owning in this fund. In the case of Apple, it provides a very interesting story in the sense that we have owned Apple in the past, but if I compare a company like Apple to Microsoft, I'm a little bit puzzled by the performance of Apple, in the sense that Apple was a company that historically used to trade at a discount to the S&P, used to trade 10, 12, maybe 13 times multiple when the S&P traded on 15 times. And if you look at the performance of Apple over the last year, not only is it trading at a premium to the S&P, it's trading at a significant premium, somewhere around 28 times earnings, at a time where its earnings growth is actually diminishing. They grow their earnings per share by low single digit per annum. They do buy back stock. So this is a company that's trading at a massive price to earnings ratio and has very low earnings growth. Compare that to Microsoft. that trades on a similar price to earnings multiple, but has, again, double-digit, very sustainable growth in its earnings, I'm much happier owning a company like Microsoft. I do accept that Apple is a defensive business. It has a huge balance sheet, and it has the ability, for example, to go and buy Disney and transform aspects of the business. So there is an optionality to it. But at the end of the day, you know, we are not going to hug a benchmark. We are agnostic, and we try and have a different view. And I think on that basis, you know, this little skit about us moving towards herd immunity is quite important. You know, although we look like we need to get to herd immunity, it's very important in this environment not to follow the herd mentality, and that's what we try and aspire to.
Thanks, Jarrod. That's a perfect place to finish off. For our viewers, thank you for watching. Please remember that the Credo Global Equity Fund is available on many fund platforms, both in the UK and in South Africa. If you have any questions or you'd like to request further information, please get in touch using the contact details shown. Thank you and goodbye.